Daniel Hynes, the senior commodity strategist at ANZ's research, joins us for more details on that. Daniel, thanks so much for joining in. Firstly, how will the Iran nuclear deal help Brent crude prices, and by when, according to you?
Yeah, look, I think the initial reaction from the markets was negative, and we saw crude oil prices sell off about 2%. But slowly over the course of the day, as the details emerged, prices started to recover. And I think that was a result of the detail in the agreement, which showed that supply, or at least exports from Iran, probably won't hit the market until 2016, when I think a lot were expecting those to be immediately lifted. So sanction relief is going to take a lot longer than expected, and thus in the shorter term the physical oil market won't see much of a change. But ultimately, in this environment where we're getting where markets are looking for supply cuts, this is ultimately a bearish signal, even if the supply is coming later than expected. And I think ultimately over the next few months we would expect to see this weigh on crude oil prices, as I suppose the realisation that the supply is still coming does start to be priced in.
Hi Daniel, we got a very interesting reaction in crude prices. After an initial dip, they stabilized and in fact moved higher overnight. Where do you see Brent crude prices by the end of the year?
Yeah, look, I think we're still looking for prices in the low 50s. Ending the year probably just below where we are now, around the $55 a barrel for Brent, that is. And that's on the proviso that we do see some sort of cut to US supply, which we obviously haven't seen just yet, and the continued improvement in demand that we're seeing both in China and the US. Obviously, though, this could change things. Certainly into 2016, I think we were looking at a much more balanced market. But if we did see another 1 million barrels a day of oil come from Iran, we could certainly see those prices, those relatively low prices, for much longer than we normally expected.
All right, Daniel, but what can Brent crude prices be once the Iran nuclear deal, say, potentially kicks in entirely? It could even be in the longer term, with global demand supply being ceteris paribus.
Yeah, look, I mean, it's a hard question to answer, but I mean, certainly if we looked at it right now, if we suddenly had 1 million barrels a day additional of Iranian crude hitting the market, then we'd expect to see Brent prices in the 40s, to be honest. But obviously there's a lot of issues at play within that, and a lot of different scenarios, I suppose, which could come out of it. So it's certainly a very sort of volatile environment, very volatile time, and I think prices obviously still have potential downside risks, but certainly over the longer term as well, we think this will weigh on prices for some time to come.
Daniel, are the metal prices reacting today to the Chinese GDP figure, which came out Q2 at 7%?
Yeah, it was obviously a much better than expected number, although there were some peculiarities within those. But in general, I think taken very positively, and so the metals have been pushing higher, which, after I suppose quite a rout that we saw last week on the back of the collapse in the Chinese stock market, we've certainly seen a little bit of short covering on the back of this stronger than expected data. And I think overall, the macro environment has been slowly improving, and despite these macro events, including Greece as well, the environment for consumption of metals has been trending a little bit higher. So this is, I suppose, just a continuation of that, and metals are seeing the benefit of that in their price action today.
All right, Daniel, then what's your outlook on base metal prices in light of the fact that growth in China is indeed slowing? So a medium to long-term outlook versus a short-term outlook.
Yeah, look, I think in light of the growth projection that we've seen China go through over the past 12 months or 18 months, it's clear that we're going to enter in a period of lower growth, and we've certainly factored that into our numbers for a lot of the metals. But metals are ones in particular, ones such as nickel and zinc, do benefit later in the life cycle of an economy like China, and as such, we still think that the intensity of use for those is quite positive over the next few years. And metals as well have certain supply side constraints which a lot of the other commodity markets don't have. We didn't see the build-up in supply like we did in markets such as oil and iron ore over the course of the past few years, and that's meant those markets are a little bit tighter. But obviously with a lower growth coming from China, we do expect to see prices remaining a little bit more subdued, but we think in the metals markets they should start to recover in the second half of this year, and we think gradually improve over the course of the next few years.
And finally, what's the call on gold? It's been largely range bound. What's the outlook and the next trigger for it to see any upside?
Yeah, no, look, it has been very much range bound, stuck around that $11.60 to $11.80 an ounce mark, and it's been surprising considering the risk-off sort of trade that's been playing out as a result of the Chinese equity market collapse and the Greek debt crisis. I suppose it just highlights the lack of investor appetite for gold at the moment, and they've really been pushing towards US dollars in this environment. For the outlook, though, it still looks relatively poor. Considering that investor demand is weak, that's backing up on what is weak physical demand as well at the moment, which all in all certainly points to further weakness out ahead. If you then consider, I suppose, the Fed and how it moves in terms of its interest rate policy now over this next 6 months, which we do expect to those rate rises to start kicking in, that'll obviously further weigh on the price. So we could certainly see gold back down close to $1,100 an ounce over the next 6 months.
All right, Daniel, then a final question from my end. We have Janet Yellen giving a congressional statement later today. What's your outlook on commodities in the background of Yellen potentially raising interest rates, maybe by even September?
Yeah, I think the result of that obviously is a stronger US dollar, and that has ultimately been a significant headwind for commodities. So on the back of that, I mean, it's going to be a difficult period for commodities. But if you consider, I suppose, a slightly more positive macro backdrop, particularly in Asia and in China, I think that probably will outweigh those negatives. But it's going to be a slow grind higher. We're certainly not expecting to see a rebound in commodity prices like we have in previous cycles, but we do expect it to remain cyclical, and that means slightly better prices. But ultimately, each one I think is going to be driven more on its own supply-demand fundamentals. So there's going to be a lot more divergence than we've seen in the past. So markets which are clearly oversupplied, such as oil and iron ore, probably won't recover as quickly as we suspect we'll see in markets like the base metals.
All right, Daniel, thanks so much for joining in and giving us all your views. But